Welcome back to Money Matters. This is DCrowell from Mortgage Network, and I am standing very close by to Emily Johnson of Polaris Capital.
We are awkwardly close. That is
We're
the
awkwardly close. In order to make the photograph work, we have to stand very close
wide
together.
angle lens. Yeah.
That's correct. In the first half of the show, we talked about refinance and the importance of doing that as it arises out of what has been a 9-year interest rate trough. The other thing that has lasted for 9 years is the biggest bull market, longest running bull market in equities history, I believe. And I'd like to know about the bull market, not just how many points are we up from this week last Friday, but how is this looking? How is it going to sustain itself? What are the headwinds? What do the economists say about the length, strength, and duration of the bull market?
Well, you get economists on both sides. On the we're going to continue to see a bull market, and then you have there's going to be a massive correction. And I truly have clients that call me pretty much weekly saying, I heard there's going to be a massive correction. I need to go to. That happens all the time. And obviously we haven't seen that. And so helping people to not walk off that cliff of putting all their money in cash because they listened to the wrong economist at the wrong time is the biggest challenge. And we've done a couple of segments, you've probably seen in the past, where we've discussed the fact that you really need to have some sort of a cash buffer because typically a bear market in its truest form, a big bear market, a 20-year decline, those types of big declines usually have a 2-year span. So if you look at where we've been in the last, is it 9 years now, I guess?
9 years now.
And I won't get the numbers exactly right, but there's typically there's about a 5% correction every, I think it's like 14 months or something along those lines. There's usually a 10% correction about every 27 months or something like that. And then there's a 20% plus correction every few years. Well, I think we're a few years past where we're supposed to actually have that. And we're still looking at where's our next 10% correction going to come from. There's lots of, it seems like we've defied logic when it comes to even these marginal corrections when you look at a lot of the geopolitical events.
I can't remember a 5% correction.
We did. China, there was a little bit of, we had a bit of a correction last year when some episodes that came to Chinese accounting and things like that.
5% correction, remember, would be about 1,000 points in the Dow. So 10%, 2,000 points in the Dow. 20%, 4,000 points in the Dow.
So is it possible that we could have those correct? Of course it is. Of course it is. And what could drive it? Any number of factors could drive it. Any surprise could drive it, whether it's a surprise in the economy, whether it's a surprise geopolitically, whether it's a surprise politically. I mean, anything could drive that. So what do you do? I mean, do you run for the hills now because we are long in the tooth? My argument would be no, and not just because you should keep your money invested, but mostly because you should keep your money invested. Because if you have your investment structured correctly, then you can withstand those down markets. And of course, the statistics always show that if you keep your funds invested over a long period of time, yes, there are down periods, but if you can withstand those, overall the trend is up. That's been the case. So making sure that you actually have a cash cushion, which is hard for some people. Number one, it's hard to save, and number two, it's hard, especially with interest rates where they are, for people to think, do I really want to have 2 years worth of my expenses sitting at 1.1% or 0.1% along those lines. That defies some logic, but that's something that a really well-structured portfolio does, especially if you're living off of the income in your portfolio. You might even need to make that a little bit bigger. And the reason for that is so that if you're living off of your portfolio, you don't actually have to sell into a bad market. You can let those funds recover from whatever the decline is.
It's hard to sit and look at a lump of cash that's pretty
doing
much
nothing.
doing nothing.
Yeah. Until you see it gone.
And then one of the reasons that we all, even those of us who are in the financial profession, hire financial advisors, is so that we don't have to look at it every day. To Emily's point, if you're one of the people who calls every week and says, get me in, get me out, get me in, get me out, you're probably watching too much because that XY axis with the ups and downs are on an incline over time. So it does go up.
Right, and it might be that if you use stock as sport, then that's one thing. But if you're actually looking at investments as a way to build wealth, it's a long-term process. So if you are interested in doing something like that, in day trading, I mean, either you make that your full-time job, but if that's something that you're interested in because you like to keep up with the markets, using a portion of your funds, say 10%, 15%, maximum 20% or so for some, depending on how substantial, your portfolio is relative to your lifestyle, it makes sense to do something like that if you're interested, if you want to learn, if it's a sport. But it is not the way, it has been shown over and over again, investor behavior is absolutely the biggest enemy of long-term wealth creation, without question. Fear and greed.
Warren Buffett pointed out the other day, and Warren Buffett is an example of the buy and hold kind of investor. I mean, many of Berkshire Capital's positions are positions that were taken 40 or 50 years ago.
His documentary, by the way, the making of Warren Buffett, is fascinating. It's fascinating. It's worth a watch.
And one of the things that he points out, to Emily's point, is that if you invest today, you're 20 years old and you start investing today, the 20,000 point Dow today will in all likelihood be 100,000 at age 70, 50 years from now. That's not a pie in the sky projection. That's not an extraordinary growth rate. That simply mimics the growth rate for the last 50 years because we've had a 5-fold increase over the last 50 years.
But you don't, on a daily basis, that's hard. On a weekly basis, on a monthly basis, that's difficult because you don't get that high that you get when you're, when you have that immediate response, right? But you do get that high when you go out and you spend money on a new pair of Manolos. You've now you have that dopamine response of that immediate gratification, which you don't really get when you are doing long-term investing and you're looking at it, say, quarterly or annually. It might not seem that exciting until at some point it actually does accumulate. But the challenge is basically not making it exciting. Or if you need to make it exciting with a portion of your funds so that's the sport of it, because human behavior we get in our own way all the time in so many ways, but definitely, and it's been shown over and over.
To my question, when's this bull market going to end?
I was thinking next Wednesday.
Next Wednesday. There's another principle. It's a principle in statistics. It's one of the core principles. It's summarized by the following very simple analogy. If you flip a coin and you get heads, and you flip the coin and you get heads again, and you flip the coin and you get heads a third time, what is the likelihood that when you flip it for the 4th time that you will get heads?
50%.
There you are. Now, 8 out of 10 of you, maybe we'll be charitable, 7 out of 10 of you would not have said 50%, because it's a very counterintuitive principle of statistics. The odds don't change. So a lot of the psychological analysis that goes into the lengthy bull market, the longest bull market of all time, is irrelevant. In other words, when the market opens tomorrow, there is no backward pressure. In other words, it will, if it's a value market, it will respond to the values as presented.
Right, and you can look at the statistics in the market or metrics right now, and you could pull them however you want to, like all statistics. But a few other factors that are pushing this market forward. A biggest one is demographics.
That's
we still have the baby boomers that will continue to. They're working longer and they're living longer, and that demographic is pushing this market to stay invested, because unless we somehow do see that big spike in interest rates where folks want to go back to bonds because they're actually getting a 5% yield in treasuries, which probably is not going to happen anytime soon, we have to keep that money invested to be able to keep up with the cost of healthcare, with the cost of food, and that is what's happening there. The other factor, interestingly, and I think we've talked about this before, is that some of the largest investors, the insurance companies, the pension funds, largely pension funds, they have to keep their money invested because those entities have promised a certain yield, mostly to baby boomers, because most folks in my generation and younger, we're not getting pensions.
They have to have investments that literally match and
they right now are assuming
every one of the commitments that they've made.
Their mandate right now is sitting at somewhere around 6.5% to 7%. That's on average. So that means that CalPERS or the state of South Carolina, their mandate is sitting.
They must earn that.
Right. Yeah. In order to meet their responsibilities. That's a big number. If somebody asked me for a guarantee on 6.5% to 7%, there isn't one. Yeah. So you have to keep those funds invested to increase the odds that you're going to get there. So that's also driving it. So could we see a blip? Sure. It could come from any of this, some of the health insurance discussion that's going on, some of the tax discussion that's going on.
Some of the geopolitical stuff.
Yep.
I mean, if you have even a whisper of a real problem in North Korea.
That's where your tax buffer, or I'm sorry, your cash buffer. I'm thinking of filing my taxes.
That's it.
Thank you
We're
very much for
done.
joining us this week. We'll be back next week with more Money Matters. Please shoot us your thoughts, concerns, issues, comments, ideas. We love them. We'll see you again.
Remember,
That's right, refinance.
Refinance.
See you next week.
Bye-bye.
Bye-bye.